Hello, and welcome to the Market Bull Podcast. Please note, topics and stocks discussed in this podcast are not financial or investment advice. Today on the show, I spoke with Rick Rule, a renowned and seasoned investor with expertise in the natural resources industry. He is also the president and CEO of Rule Investment Media. On the show, Rick spoke about his journey and the learnings he's had over his 45-year career in investing. He talked about the network of people he has met over the years and the stories of the business deals he's had. Rick also discussed how he evaluates markets, in particular commodities, and his investor methodology. The Rule Symposium is being held in July this year, and Rick talked about what it covers, the expert speakers he has, and why he has been so committed to running this event for so long. Rick also offered some great tools for investors to use to help them evaluate their own portfolios. I hope you enjoy listening. So hello and welcome to the Market Bull Podcast. I'm your host, Ben Kostrich, and joining me for his first appearance on the show today is Rick Rule. Welcome to the show, Rick.
Pleasure. Thank you for having me on.
I would assume, or I'd hope a lot of people have heard of you, but you're an extensive and experienced investor, particularly in the commodity space. You're the president and CEO of Rule Investment Media, which assists investors in constructing portfolios. And I mean, you've been in it for so many years, 45 years experience. You've clearly been through a lot, but if I throw your mind back to where it all started for yourself and your history, how did you get involved in investing and speculation in the commodities industry?
Well, this will make me seem like a very dull man who grew out of a very dull boy. But I emigrated from the United States to Canada in 1970 with the view to getting a degree in natural resources finance. Why a young 18-year-old wanted a degree in natural resources finance is something I actually can't remember. But I've been fascinated with all aspects of resources, geology, of course, hard and soft rock, but also forestry and agriculture for as long as I can remember. I had the good fortune before my career started of being introduced to Peter Cundall, who was a legendary deep value investor. People who don't know who Peter Cundall is should Google him because he was truly a spectacular human being. And in terms of my investment acumen and my investment discipline, financial discipline, I had the good fortune to learn it all at the knees of the master, beginning at age 20, which was a wonderful thing. Being in Vancouver in the early part of the 70s meant that I resided at the epicenter of the exploration boom that accompanied the commodities boom through the decade of the 1970s. I could not have been in a better place to learn the exploration industry because it was financed out of Vancouver for all of its warts. The second formative experience was through the decade of the 70s, natural resource prices, commodity prices went crazy. Commodity stocks went crazier. And I, like many young men, confused a bull market with brains. I thought I was doing well, not because the gold price went from 35 US dollars to 850, but rather because I was smart. When the commodities boom busted in 1982, I learned just how smart I was, which is to say not very. I went from being an extremely wealthy and hubris-ridden young man to a young man with a negative net worth, with some of the rough edges, let's just say, sanded off. But I also came out of that experience with some wisdom and some knowledge, which is to say that markets work. I learned my mantra today, which is that in natural resources, you are either a contrarian or you are going to be a victim. And I learned, too, that markets, however messy, work. The cure for low prices is low prices. The cure for high prices is high prices. The investor's response is at once contrarianism and patience. And contrarianism and patience have been the hallmarks of that part of my career post the 1970s, which has been successful.
And I mean, if you're going back to yourself as a young man, as you said, being in a way burnt and really roughened up and humbled, I would almost phrase it. What drew you then to go back to that? Because for a lot of people, that would have been a scarring situation. I can imagine a lot of people, even now, given the COVID pandemic crash or the rise, everyone thought they were a genius, and then realization kicked in. I mean, how did you dive back into it and continue pursuing that resource and investment sentiment?
Well, Tom, I had a negative net worth. which meant that I owed more than I had. And the only way to pay off the people who had believed in me, who were my creditors, was to go back to my strengths. One thing that happened is that in addition to me owing other people owed me money too. And I began to be a bit of a credit and bankruptcy and workout specialist. I did it partially to get paid back so I could pay back other people. And I did it too because I developed some skills in bankruptcy and workout that allowed me to make enough money to pay off everybody who had loaned me money. And paying off the people who loaned me money was a very important part of my sense of self-worth. I didn't want to walk on my debts. I didn't want to scar my reputation with being regarded as a Welsh. Uh, and so I honestly didn't miss a beat. I had, I don't know if it's the wisdom, but I had the common sense to understand that my then predicament was a consequence of my own hubris. And I had a sense of responsibility to clearing both my name and my balance sheet. And
Mm.
the only industry where I had the contacts and the knowledge to allow myself to do that was in the industry where I got myself into trouble. So I didn't have a second choice. I was very fortunate in the sense that there is no way to learn credit, uh, which is an important part of the cost of capital and resources, like working companies out of bankruptcy, which I did. So while I would say that the decade of the 70s was very much about me learning the equity side of the business and the business part of exploration in particular, rather than production, the early part of the 1980s is where I really learned the ins and outs of balance sheets and credit. And that knowledge, uh, the credit side of the balance sheet, financial structuring, has been, again, a hallmark of whatever success uh, I've had since. The other thing that happened is that some fairly prominent players and resources watched me work my way out of my difficulties rather than walking, which is what most young men did. And the consequence of that is that two of the people who I owed money to, who never thought they'd see their money back, became my most important clients and sponsors through the decade of the 1980s and 1990s. So it was really a consequence of making lemonade out of lemons, I guess,
Well,
that
you've
allowed me to get
proven,
ahead.
yeah, it proved that you really, as you said, it was yourself, it was your own fault. You had to work your way out of it because it's going to follow you no matter where you go. And then, I mean, going through that, the 1970s, I mean, you would have learned a hell of a lot through that. And then up into the 90s and even into the 2000s, you've amassed this, naturally, this network and following of investors. I mean, how has that all evolved throughout your time? Because clearly it's a proof of concept. You've proven that you can do it and you've learned a lot. But how has that all evolved throughout the
The
40-year career?
the honest answer is I worked very hard, but I've been lucky. Uh, Early in my career, I suspect because I had so much energy and worked so hard, that older people who had been successful recognized in me the energy that had propelled them to success. And for whatever reason, I've been graced through my career with spectacular mentors. When people ask me why I appear on podcasts for young people like yourself,
Yeah, well, exactly,
uh,
yeah.
I say to the extent that I don't help young people start out, that I'm disgracing the memory of the people who helped me out when I was in my 20s and 30s. So I had somehow, uh, I was able to attract mentors and frankly, business partners, people who I became indispensable to because of my energy, who became superstars. In your country, Robert de Crepney, not well known now, but he, founded Normandy, which is now part of Newmont. Wonderful guy. Owen Haggerty, years later, the sort of, Tigers Realm group. Uh, More internationally, Robert Friedland, when he started out, the resource superstar. Uh, the Lundin family. I did my first transaction with the Lundins in 1974 at the ripe old age of 21. And I've been lucky enough to be close to the family now in the third generation
Jeez.
ever since. And then, of course, my original mentor, Peter Cundall, who taught me value investing and credit before the market taught me credit.
Mm.
These were truly spectacular mentors. And when I think back to how much of my career has involved making myself, because of my energy or my own contacts, indispensable to superstars, I would suggest that literally all of my success has been due to associating myself with extraordinarily high quality people. As we speak, I have a house guest, Bob Quartermain, who I met in the early 90s as a toiling geologist for Teck. He went on, with a little bit of help from me, to his first success was Silver Standard Mines, which he took from 72 cents, where we financed him, to $45. Pretty good success.
Yep. Relatively. Yep.
He followed on from that to take an asset out of Silver Standard, after Silver Standard became SSR Mining, called Pretium. Pretium was ultimately sold to Newcrest in a sort of a $2 billion takeover. And he has moved on from that in retirement to reassembling and exploring the Homestake mining district in Lead, South Dakota, which is outside of Nevada, the biggest gold district in the United States. I've done business with Bob continually since the early part of the decade of the 90s. And that's very useful. The first financing discussion that Bob and I had in 1991 or 1992 probably involved 4 days and probably 40 hours of torturous negotiation. We have since probably done 15 transactions together, and I would suggest that the total elapsed negotiating time in those 15 transactions has been an hour, because we know and trust each other.
Yeah.
And not having to do business with, in Australian parlance, Wallies, but rather doing business with absolutely top quality human beings who you already know and trust from prior endeavors, is a wonderful, wonderful, wonderful capital and time saver. And I've been very lucky to have assembled a cohort of people, really in my 20s and 30s, who have been responsible for my success now into my 70s.
Well, it's an incredible story, because I just keep flashing back to it. Like, me sitting here now, it's a completely different world. The fact that I can jump on a phone call and we can talk right now, that would have been completely different in the 70s, 90s, 80s, 2000s, whenever business was being done. And now it's completely revolutionized. And I can happily
It,
say,
it,
it's,
it is true. Technology is so much better today. And frankly, for all our faults, society is better today. When I was a young man, and I don't want to sound too woke, too politically correct, but when I was a young man, success looked like me.
mm,
It was white, it was old. Success doesn't have to look like me anymore. Success today means that you have access through education and technology to Chinese entrepreneurs and African entrepreneurs, and you can find funding sources among users of commodities in Japan. You can make contacts with project originators who are Brazilian and Chilean, and you can do it from Perth.
yeah, it's a
You know, I ha-
globalized work.
I had to do it in bankruptcy courts in West Texas, where I met people, fought them absolutely viciously over uh, remaining assets to secure liabilities, and come to understand them as adversaries before they become friends. You can do it now online, which, believe me, is a better way than in bankruptcy court.
Agreed. Well, and that's the whole transcendence of where we are now. And I keep going back to, given the amount of time you've had in the market, you can always say that things have changed, but in a real sense, markets don't necessarily change. And I know you're a big resource investor. I mean, when you're looking at the resource sector, you would have seen so many ups and downs. And in particular, now we've got, lithium is clearly a prized commodity at the moment that everyone is looking for. You've got gold, you've got uranium, but I mean, what are you seeing in that field of resources really accelerating again? And why do you appreciate certain commodities over others?
Well, the commodities businesses are deceptively simple if you manage your emotion. When you have a commodity where the demand for it is assured because it's a necessary component of the material advancement of humankind, and where the commodity is in oversupply to the extent that the industry as a whole is unprofitable, which is to say, the price of the commodity understates the cost of producing the commodity. In that circumstance, the commodity is out of favor, but it has to go up in price or the way we live changes. Those are no brainers if you have patience. So you talk about lithium being hot. If something is regarded as hot, I'm not there. If you have a commodity where the operating margins exceed 50% and the cost of capital goes sub-zero, which is to say that butchers, bakers, and candlestick makers in West Perth can raise $5 million to explore for lithium in some place where 5 years hence they couldn't pronounce that place, I'm not in the space.
Mm,
But if you look at something that's deeply out of favor, say coal or uranium, where despite the wishes of the big thinker, demand is assured because they are an essential component of the material advancement of humankind, I'm on that like white on rice. And I'm willing to be 2 years early or 3 years early or 4 years early. I have a phrase in my career that I look for things that are inevitable, but maybe not imminent. Many of my competitors seem to have trauma holding stock over a long weekend. And I have learned myself that in the speculative part of my portfolio, that part of my portfolio where I search for 10 baggers or 15 baggers, that type of return requires 5 or 6 or 7 years. It requires the willingness to endure 50% share price declines, periodic 50% share price declines. And so for me, what is hot is not. Markets work.
interesting. Yeah. Well, and that's a key component there about the psychology of investing and the idea that share prices or commodities don't go up forever, and there are going to be sharp declines, but the emotion component of a lot of people forces people to sporadically sell and to almost cancel their game plans. And I mean, if you're looking at that, given what's happening now, we shouldn't say lithium, but I mean, you're looking at uranium now. Clearly, there is direction trending in that commodity. I mean, what are you seeing evolving in the uranium space? Because I've spoken with a few CEOs and guests about it, and I've been a big fan of it for the last couple of years because, as you pointed out before, it's almost been an unloved commodity. But now, as soon as the news cycles start covering it, I start thinking, well, what does that mean? Does that mean every man, dog, and his bone is going to be able to do the same thing?
Well, let's look at the last uranium bull market, which is instructive. And by the way, since we're having a discussion, interview a neighbor of yours, John Borshoff in West Perth. He's a superstar. I've done business with John Borshoff since 1997, 1998, a very long time. So let's take ourselves back to then, 1997. Uranium had been in a bear market since 3 Mile Island in the United States in sort of 1981. Now, this is a real bear market, a 15 or 16-year bear market. And uranium was a special commodity. It wasn't just that people were bored of it because it hadn't worked. They hated it. They were hostile to it. If you advocated on an investment podium for uranium, people accused you of being in favor of Hiroshima, Nagasaki, 3 Mile Island, Chernobyl,
Yeah, you're a
and as
devil.
a contrarian, a commodity that's priced at less than the cost of production that people hate is like catnip. It's probably the most,
Addictive.
as an instinctive contrarian, if you run into not merely boredom but hatred, you have to be drawn to it like a moth to a light. So if you take yourself back then to 1997, 1998, the total cost of producing uranium, not the AISC, but the real cost, taxes, social rent, prior year write-downs, cost of capital, was between 25 and 30 US dollars a pound. The price of uranium was $8 a pound. So the industry is making the stuff fully loaded for, let's call it 30, selling it for 8. Losing
Not ideal.
$20 a pound and
Not
trying to make
ideal.
it up on volume. It wasn't working. And I just thought, in the United States at that point in time, uranium accounted for 20% of energy supply. Either the price had to go up or the lights had to go out. Those were the only two choices. And I reckoned the lights weren't going to go out. So I set about learning all I could about uranium. And in the thriving metropolis of Kalgoorlie in Western Australia, at an old conference called Diggers and Dealers, it still exists, but it's a shadow.
It is. It's coming up soon, actually.
Yeah, it's a shadow of its former self. I mean, it's a better conference, but it's less fun sociologically. I'll leave that alone. I met John Borshoff, and he had a little deal called Paladin Uranium. And the asset of Paladin was that he had explored the world for uranium on behalf of a West German consortium. And when they pulled out of the uranium business, as part of his severance, they gave him a worldwide database that reflected $1 billion in exploration. And they gave it to him. And so when he was explaining how he'd grow this little Paladin, I said, come on, you only have a $2 million market cap. How can you find anything with $2 million? He says, I can find it in my files. I have $1 billion worth of exploration data from around the world. I don't have to find any uranium. Nobody wants it. All I have to do is stake it. I've already found it on somebody else's money. Really good story. So I wrote with my clients, John Borshoff, a check. We bought more than half the company at 10 cents a share with a warrant. And I just, I was really happy about this. And for a second, I learned later, because I was involved, the Australians sensed fresh meat in a small market, American meat, and they were looking forward to victimizing me. The stock went from 10 cents to 11 cents to 12 cents to 13 cents. All good. I'm feeling smart. But after 6 weeks, the furor engendered by the Australian punters looking at fresh meat declined. And the price went from 13 to 12 to 11 to 10 to 9 to 8 to 7 to 6 to 5 to 4 to 3 to 1. Went from 10 cents to 1 cent. So if you have a stock in your portfolio that goes from a dime to a penny, you don't have a hold. You have a buy or you have a sell. Those are your two choices. Mercifully, I reacquainted myself with the story. I said, either I'm wrong or the market's wrong. And I decided that I was right, that the market was wrong. There was a financing risk, which is to say that Paladin could run out of money. But if I gave him money at 10 cents, I better be willing to give him money at 1 cent. And mercifully for me, I had the courage of my convictions. I held on. I introduced a couple North Americans, in particular Ned Goodman, to the story. And the stock went in 6.5 years, torturous years to be sure, from 1 cent to $10. The price of uranium went from $8. I thought that the price of uranium could go to 40. I was wrong. It went to 140. Now, let's look at the contrarian aspect of this. At the beginning of that wild bull market in uranium, when we were still in a dismal bear market, there were 5 junior companies worldwide looking for uranium that had survived a 16-year bear market. There were probably 12 to 15 exploration teams that could have been assembled worldwide that had enough knowledge of uranium to be credible in it. At the end of the bear market, the beginning of the bear market, the price had to go up or else the lights would go off worldwide, right? Worldwide. Those were the only two choices. So at the beginning of the market, the price of uranium has to go up. At the peak of the bear market, with the uranium price over $100 a pound, and with Kazakh production coming on, it was very obvious that the price was going to go down. But because it had gone up, there were bullish expectations. At the beginning of the bull market, there were 5 companies looking for uranium, with 12 or 15 teams capable of finding it. At the end of the bull market, there were 500 companies looking for uranium, with the same 15 competent teams. So the calculus around whether your uranium junior had a competent team running it was effectively taking the supply of competent teams, let's be generous and call it 15, and dividing it by the aspirants, 500, which is truly, truly lousy math. That's why bear markets are best for buyers. Bull markets are all about monetizing the effect of the courage that you had in a bear market. So I'm in constant search of bear markets. I'm in constant search of opportunities to test my character by buying early with fantastic entrepreneurs like John Borshoff. I'm even in search of stocks that fall by half because I'm too early. I've learned in my life, as an example, the great entrepreneur Ross Beatty. I've probably backed Ross Beatty, I don't know, 12 times, 14 times. And most of those, not some of those, most of those have gone 10 for 1. But everyone that's gone 10 for 1 has required 5 or 6 years. And everyone that's gone 10 for 1 has at some point in time delivered me a 50% share price decline. It isn't that the company's worth 50% less, it's that market conditions and market sentiments change. So I hope that helps. I want to use the uranium backstory to talk about what you need. So let's fast forward uranium, okay? Now, the spot price fell from 140 all the way back to 12 as a consequence of Fukushima. When the Japanese demand came offline and the Kazakh production came online, we went from having a deficit in uranium production to a surplus in uranium production. And with the Japanese reactors gone, the price of uranium fell like a boulder off a bridge. But the cost of producing uranium, particularly the social costs, the rents, increased. So then we had a situation where let's fast forward to today. The true incentive price for existing production is about $60 a pound. If you add in social rents, if you add in the cost of capital, and if you add in amortizing prior exploration and development failures. So 3 years ago, we had a circumstance where the total global cost to produce uranium was $60 a pound, and the stuff was selling for 20. It had to go up or the lights would go out. Those were the two choices. I mean, you had all these fringe morons. Some of them ran Australia. You had Angela Merkel. You had all the big thinkers of the world who said, we're going to power the world on wind and solar and all that kind of stuff. But then you had people who could do arithmetic, who knew that that wasn't true. The price of uranium had to go up, and it has gone up. The price of uranium that you see right now is deceptive. As I see the spot price now, it's about $57. But what's happened is that more and more uranium transactions are taking place in the term market, the contract market, which is opaque. But we're seeing contracts go through that are at $62 and $63 with built-in escalators. So the market sees 57, but the user sees 62.
Discrepancies.
And the price goes higher. The pace of Japanese restarts has accelerated. So the reason for the real precipitous decline in the uranium market is over. Public sympathy for the uranium business in Japan has gone from 32% positive to 62% positive as the Japanese strive to meet their Kyoto protocols and as the Japanese react to geopolitically secure energy. You can store uranium, but they can't store natural gas. They can't store coal. And in particular, they can't store hydro, right? So they have to be in the uranium business. Meanwhile, on a global basis, demand for uranium has exceeded the demand that existed pre-Fukushima, which is to say the 30 or 35 million pounds a year that the Japanese used to consume are now consumed by the Chinese and the Indians, and the Japanese demand is coming back layered on top of that demand. Now, will this happen in 2023? I don't know. I don't care. Will it happen in 2024? Probably. If it doesn't, will it happen in 2025, 2026? Absolutely.
It's, as you said, it's getting earlier.
We'll look at the market and say, well, this uncertainty over time is more than I can bear. Well, maybe, but I prefer the phrase inevitable. It has to happen to imminent. It has to happen quickly. Most people take bets on things that don't have to happen at all.
Yep. That's a good way of putting it.
So
I mean,
that's why I
yeah.
like the uranium business.
And I mean, look, when you're saying you're looking for bear markets, you mentioned coal as well, and I mean, it went. I mean, I could say I wasn't surprised seeing that coal was one of the most profitable returning commodities in 2022, when all we were hearing was coal as a demonized commodity
Yeah.
and it had to be taken away, and it was outperforming everything in a year that really everyone almost wanted to turn away. So, how do you go about looking for these markets? I mean, I can imagine there's a hell of a lot of research or just looking for these bear commodities and opportunities. I mean, what else are you looking for and looking at now?
Buffett says it ought to be obvious. Uh, and I just saw coal as being completely obvious. The big thinkers in the world, and by the way, I'm not advocating pumping more crap into the ocean or more crap into the skies. I'm not going to get into the global warming debate.
Mm,
But you have a circumstance where, despite what the big thinkers want, when you walk into a room and flip the switch, you want the lights to come on, right? And coal is a requirement of that. There are a bunch of places in the world that don't have the luxury of unaffordable energy. There are a billion people in the world right now that have no access to electricity at all. There are 2 billion people in the world that have access to intermittent or unaffordable electricity. One of the great unsung successes of humankind is that in the last 40 years, we have taken most of the uh, abject poverty in the world and made those people just less poor. And this progress in humankind continues. And energy is a central component of that. And coal is a central component of that. When we have discussions in Germany, which by the way is burning lots of coal, the United States, Australia, all these rich people, all of us sort of, I don't know, lotus eaters about the world we'd like to see. And we consult with these noted energy physicists like Greta Thunberg or Angela Merkel. We're totally divorced from the reality of humankind. Poor people around the world want to live like you and I. And over the last 40 years, they've become more able to do so, and that will continue. And part of that will be fed by coal, whether or not the big thinkers like it. Uh, you will see, I think, peak oil demand, which my president believes will happen in 2030. You'll see it happen in 2055 or 2060. That's peak demand. And by the way, it won't end in 2060. It'll just cycle off from there. So when you do net present value calculations around oil and gas fields, the big thinkers in the World Economic Forum, and all these morons, talk about terminal decline in 2030. It's fiction. It's fiction. You don't have to do net present values with terminal declines in 2030. You do net present values with terminal declines in 2060. And on a net present value, cash flow that happens after 2060 doesn't matter anyway. So the oil companies, the well-run oil companies, the guys that get good returns on capital employed, the guys that could spell oil 5 years ago, uh, these guys are stupidly cheap. Can they go down in a recession? Yeah, and they'll come back.
back. Mm,
Look at the fortunes of the Western Australian iron industry. It's been up and down like a horse drawers. But the fact is that Western Australia is the lowest cost, highest quality iron producer in the world. And when the price of something like Fortescue is off by 50%, it's off by 50% for 2 or 3 years. And then it roars on ahead by 300%. Having the good sense to understand that demand for iron will continue as long as Homo sapiens can breathe, and the understanding that when the iron price is less than the marginal cost of production for the marginal producer, that it has to go up, makes you a better investor.
I mean, as you said, it's simple. It's obvious. It's not rocket science. This is
Tough to do,
mm,
but it's easy to conceptualize. And the longer you do it, the better you get at it. When I get concerned now about the share price performance of a speculative stock, knowing that I have the ability to weather a loss, And I remember the Paladin lesson. The fact that I lived through that lesson gives me the courage to stay a trade where the probabilities are that I'm going to be successful.
Okay. Well, it is. It's, and I mean, I can say I'm emerging into this field, and even just my exposure to, how would you say, adversity is apparent. And I'm not, I can happily say I'm not playing with big figures, but even still, in everyone's position, you're tested at different price points, and that is the key of what is your game plan? What is your objective? Are you in it for, a quick return? Are you trying to buy a quick car, or are you trying to set yourself up for a 10, 15, 20-year investment? And given that, yeah, I always look to some of the tech companies. Apple is one of currently the biggest company in the world, I believe. And they've had 50% decreases all throughout their time. And,
Right.
you look at the quality of that company, it's, in those periods of time, there's just been this sporadic selling. The company has not changed day to day, but that presents the opportunity to get back in. And even now, Apple's broken all-time highs. And earlier in the year, it was, not on its knees, but it'd come off a fair way. So now, I mean, there's a lot going on in the world, and you've talked about this network that you've built up, and I know you have an event coming up, the Rule Symposium. Can you give a little bit of information about that? Because this, I can imagine, is, I mean, you've run it a few times, but this is just a collection of industry experts and professionals that you've interacted with that are all coming to talk about the commodity space and the world of markets. So tell us a bit more about that.
I'm told by my staff that I took over what is now the Rule Symposium in 2002. Uh, and so the conference has gone on for 21 years under my stewardship. It is not an investment conference, it's a natural resources investment conference. We don't try to be all things to all people. We focus on natural resources, and we focus on mostly small cap resources. We have some exhibitors like Franco-Nevada and Wheaton that started with us when they were small cap companies and are now large cap companies and have stuck with us because they like to speak to their shareholders. The conference itself has 5 or 6 themes that are important for investors to understand. Um, First of all, we try to assemble big picture thinkers, gurus, if you will, who explain a worldview that in Australia you would not see on ABC, or we would not in the United States on NBC, or the British would not on BBC. People like Jim Rickards, who analyze, as an example, the US market from the point of view of being, lawyers on Wall Street or policy analysts for the CIA. Nomi Prinz, Doug Casey, Bill Bonner, people who look at the world from a contrarian point of view, a macro contrarian point of view, and point out things that are fairly obvious, but only to people who look. Uh, but after we've done that, after we've shaped your worldview a little bit or altered your worldview, we have assembled a group of analysts and portfolio managers who have been in the resource space for 30 years, old gray hairs like myself who have stood the test of time, who show you as an attendee, if you agree with the worldview put forward, how you implement financing strategies to take advantage of that worldview. More importantly than that, we assemble 5 or 6 people who we call the living legends, who have built multi-billion-dollar natural resource companies from scratch. The Ross Beattys of the world, the Bob Quartermains, the Robert Friedlands of the world, the Lucas Lundins, rest in peace, of the world. And we charge them with educating investors, saying, these are the lessons that I learned building a multi-billion-dollar company from scratch. This is how these lessons have made me a better investor, and these are how the lessons can make you a better investor too. These are the attributes that go into a serially successful entrepreneur. This is what you look for in a younger entrepreneur. And by the way, this is what my next deal is. It's critical that you surround yourself in the racket with serially successful people. And one of the advantages I have, having been in the natural resource business since 1974, is I've become pretty good at separating, in movie parlance, the good from the bad from the ugly,
The ugly.
and attracting the good. But it gets better than that. At most investment conferences, the qualification to be an exhibitor is a pulse and a check that cashes in reverse order of importance. In order to be an exhibitor at the Ruhl Investment Symposium, your company has to be owned in accounts owned and managed by Rick Ruhl. Now, sadly, that doesn't guarantee that every stock I buy goes up. What it does guarantee is that every exhibitor has been vetted well enough that I have an investment in terms of time and treasure in that company. The fifth is ours is the only investment product that I know, investment education product in the world that I know of, that has an ironclad 100% money back guarantee. If you attend the symposium in Boca Raton in person or from the comfort of your home, live streamed in Western Australia, two things. You'll have access to the conference tapes online for 6 months afterwards so that you can absorb the information over time. But more importantly, if you don't think you got your money's worth for any reason, email me and I'll give you your money back. In 30 years of making those guarantees around investor education, I've probably had to refund less than 0.1% of the tuition charge. But the fact is that I stand ready, willing, and able to do that. So if the advantages of this world-class paradigm, these world-class analysts, these world-class living legends and vetted companies isn't sufficient, if you don't believe you got your money's worth, email me. I'll give you your money back.
No, it's sold me, and it's coming up in next month. It's July. When I saw it, again, a few of the names caught me, and yeah, the biggest appeal is that naturally, if you want to be there in Florida, you get to shake everyone's hand. It's a little bit different sitting in Perth, Western Australia, but the idea that you can
It actually
watch them,
is better if you can attend it, to come in person.
Yeah.
One of the things that happens in a conference like that, where there's 500 rich, successful investors, is that you get to learn an awful lot at the bar, or in the buffet line, or around the coffee pot. Here, we invite those attendees who want to join us on an informal boat cruise, where we go up the Intercoastal Canal, have wine and beer and cocktails together for 2 or 3 hours, and the exhibitors are there right along with you. So you can have a beer with the CEO of a junior company that you're interested in. It's a wonderful set of circumstances. There are those who can't afford the time to fly from Perth to Boca Raton. I understand that. And for them, the live stream is second best. And it's still worthwhile. And as I say, if it isn't worthwhile, the risk is mine, not yours. Say, I didn't get my money's worth, Rick. I want my money back. Done.
I like it. I only was raised to this recently, and even myself going through the agenda and the speakers, it sort of took me aback. There's a lot of experience, a lot of knowledge, and a great opportunity. But yeah, thank you so much for this conversation. This has been, well, a lot has been covered. I think the Paladin story has really resonated clearly with you, but I think that's a really good lesson for a lot of people to take note on, and just seeing your philosophy through the years. But for listeners that want to learn more about Rick Ruhl, naturally, where can they go and get access to your information and your wealth of knowledge?
The best way to do it is to go to my website, Ruhl Investment Media, and I'll give you some incentive to do that. Any of your listeners who care what I have to say about natural resources can find out what I have to say about their own personal portfolio. Go to ruhlinvestmentmedia.com. List your natural resource stocks. By the way, I won't know every Western Australian penny dreadful. I won't. We follow about 800 companies out of 3,000 listed companies worldwide. But I will, on a no obligation, no payment basis, rank your natural resources portfolio, every company in it, 1 to 10, 1 being best, 10 being worst. I will comment on individual issues where I think my comments might have value. For those people who want information on our seminars, both live and virtual, write in the question and comment section, seminar, pretty simple. I'll send you information. For those of your listeners who are accredited investors, those people who can afford the risk, both financially and psychologically, of private placements, if you care about what private placements I'm participating in, Australian, Canadian, British, American, South African, write placements. And I'll put you in a no obligation database where I tell you precisely what I'm doing with my own money, when and why. No guarantee that because I get into placement, you will, but there is a guarantee that you'll understand what it is I'm doing with my own money, what the names are, and why. It's absolutely free. If you are an accredited investor, if you are able to participate in private placements, and you care what I'm doing with my own money, in the question and comment section at ruleinvestmentmedia.com, write in placement.
Again, another awesome resource. Again, I think I know it's definitely something that I'll be looking to take up at least. But thank you so much, Rick, for taking the time to speak with me today. I'm looking forward to seeing how the Rules Symposium goes and hopefully touch base again in the coming months to see what's been evolving and hopefully dive into a bit more of the commodity movements and where the movers and shakers are happening. So thank you so much for speaking with me on the show today.
Always a pleasure. Best of luck to you and best of luck to your audience.
Thanks for listening to the Market Bull podcast. If you enjoyed it, please make sure to like and subscribe. You can follow the Market Bull on our socials at Twitter and LinkedIn by searching The Market Bull. You can also subscribe to our newsletter on the website by visiting www.themarketbull.com.au.